Hi everyone, welcome to today's live Q&A session. I'm Harshit and I'm thrilled to have you join us. Whether you are turning in live or catching the replay, you are in for an insightful session today. Today I'm joined by a very special guest, Anubhav, an experienced buyer's agent in the Australian property market. And Anubhav has helped countless clients build successful property portfolios and achieve their passive income goals. Thank you for being here, Anubhav.
Thank you for having me, Harsha, today once again.
And we, Anubhav, there are so many jargons in the property area. Portfolio, strategy, passive, active, so many things, negative gearing, and all that. So today, I would be focusing on some of my clients or the audiences. They are just starting their journey. They get overwhelmed with all these big words, and some are astute investors who have already gone through these ups and downs and everything, and now they want a strategy how to scale further. So I'll try to keep it simple for my general audiences who are starting their journey in the property investment, how it looks like, and for the astute investors as well who are looking for keywords, how to scale further. And the topic today is quite interesting because people have been just thinking about passive income. How can I generate a passive income? And there's so many ways to achieve passive income. There is a journey to achieve that passive income, right? So everything comes based on what you want to achieve. What are your goals, right? That's my understanding of being in this industry, and having multiple sessions with you and other people on this platform, Anubhav. So first of all, Anubhav, when people talk about portfolio, what is portfolio for my audiences?
So a portfolio is you could have multiple assets put together and you call it as a portfolio. So it could be multiple types of assets as well. Share is a portfolio. So if you have a bunch of shares, that's your share portfolio. If you've got multiple properties that you own, that could become a portfolio as well. Or you could call it portfolio at large, which has got your gold, your shares, your property, and other things that people buy, including crypto, for example. You could call the whole thing as a portfolio as well. So it's basically investment portfolio.
So in the property terms, does that mean portfolio is different strategies in my property portfolio? It says something is commercial, residential, different states, different type of strategy, Airbnb, home and land, or some strategies of I would say some different strategies related to, so all related to property. Forget about other stuff which financial planners do, right?
Yes. So let's say, keep it simple, as you said earlier as well. So if you had, if someone is keen to build a portfolio and a property portfolio, you would go through a journey. And what that means is you would buy your first property. Maybe it's your home, which is also part of your portfolio, but it's not investable portfolio because you're not getting any income from it. But it is your home. It is still part of your property portfolio. And then usually then people buy their first investment, then second, then third, then fourth, and people think they need to continue buying properties, although that's not true. You could even retire depending on how much money you want as passive income. You could retire even with 3 properties or even 4 properties, or maybe even 2 properties. It just depends on what you're buying. So what you referred earlier is different strategies that will unlock different types of outcome for that particular property. But overall, a mix of strategies in the portfolio with these multiple properties that they acquire can actually absolutely boost how they actually buy or build a portfolio and a sustainable portfolio over a period of time.
So just on portfolio, the keyword that comes in my mind if I'm an investor is risk and return, right? So how do you help clients balance risk and return when building a portfolio focused on passive income?
Look, I've got a key example for that. So when we talk passive income, firstly, that needs to be understood as well. So passive income means that it's an income that is being generated through your assets for which you are not working towards it, but it actually is coming in your bank account whilst you're sleeping. So it is working for you rather than the other way around, right? And a lot of people are so much focused on growth, which is great. But what they forget is that cash flow is also equally important to try continue to build the portfolio, or at any point in time in their life need to replace their active income, which is usually coming from their jobs or businesses, where they're putting in their time and effort to generate the income they generate today. That needs to be replaced at some point in time in the near future, so they need to start do something today to be able to do that. So when we look at a client's position, we are looking at what is it that client currently owns, what is the situation, financially, are they, how many properties can they even buy over a period of time with the current incomes and debt position that they have. So we have range of different professionals that we work with that can actually help in understanding the client position better, including the financial planners, brokers, and the accountants. In fact, this morning we were on a call with a financial planner, broker, and myself, and we were going through an understanding of how a client would, if a client would benefit buying their personal PPR, which is their principal place of residence, primarily your home, and a 2.5 million home versus actually saying, would you build a portfolio worth 2.5 million as opposed to buying home and continue renting? So these pros and cons can vary depending on personal situation and goals that people have in their lives. But the risk is also associated with perceived risk versus actual risk of an asset and of a portfolio. So the conversation cannot be held in isolation. It has to be a discussion based on individual appetite for that risk, and also trying to understand how you could continue to unlock your next property after you buy your first, second, third, in which you don't get stuck in order to buy the properties as well.
Hmm. So, just on that, when we are building a portfolio, people today, the background that we come in, our parents and everybody just says, hey, reduce your debt. And now we are talking about passive income in parallel. So, how we marry them together, because they take us in opposite direction. To build a portfolio, we need to take more debt, and our parents' upbringing or whatever the thinking is mainly, hey, reduce your debt. So how are you going to, can you, this is a myth, how will you demystify that?
Yeah, look, I guess it's a very important point, actually. It's how we've been brought up, right? In the childhood, we've always heard, use your money, don't borrow. Or loans were really difficult back then. We're talking back in, early 1900s, where people believed in actually just the money that you save is the money that you earned, and that's the money that you should be buying your assets with. It's a slow process, slow game. In the modern uh, times, this doesn't exist right now anymore. More and more people are now very comfortable with debt, whether it's credit card, personal loans, car loans, home loans, and people are happy to take that because it's still a very calculated risk based on the incomes that they earn. So if you want to be wealthy, and you want to basically ensure that you can secure the right future for yourself, I think debt is important, to a large extent, that can actually leverage so that you can go and continue to build the right portfolio. I mean, how long would it take for you to save, $1 million, versus actually making that sort of money with a portfolio that you can build, by leveraging with loans.
It's a bit of challenging the old school thought. I understand that, but yet there are benefits to it. As the world is changing, technology is changing, everything is transforming. We need to rethink how we do
Yeah.
things, right? And
One,
post
one
COVID, we have seen a lot of things as well changed.
Yes, sorry. So one of the case studies, for example, is a lot of people, they end up buying their first home and they get very emotional with it, and then they hold that property for some time, and then they first focus on paying that fully down, for example, right? And there's nothing wrong in that view, but what happens is, how long does it take to pay that off? Could be even 4, 5, even 10 years, depending on how fast they're paying that off as well. Now, of course, the loan may be set for 30 years, but usually it doesn't take 30 years to pay off the loan. You could probably do that faster, depending on your repayments, your offset accounts, and so forth that you may have set, or maybe constantly just rebalancing the principal and interest component of it and ensuring that you're on top of your payments and paying off your debts. But the point is that you've lost those 10 years to pay a house down, and now you're going to save for your property portfolio to be built. You've lost significant amount of time where that could have been utilized to build a portfolio. So again, this is not an advice, but if I have some money, for example, if I have $200,000 that I can actually put down and pay off my debt on my principal place of residence, I would rather not do that. I would pay that off. I would re-borrow that, which is called debt recycling. And now I can use that 200K, which is re-borrowed back from my own property, and actually buy an investment property. Which what that means is that this 200K that I've actually paid down my own loan for my own PPR or for my principal place of residence or my home, that particular loan is actually going to allow me to now get tax deduction as well. Because earlier that was not possible. It's called bad debt, and I'm doing it against my house. Now that I have paid it off and I've re-borrowed for my investment, it's now tax deductible. So again, I'm not an accountant, but that's how usually the debt recycling works. That you re-borrow the same funds, and you still have the loan of 200K, but now that is tax deductible, essentially against the investment. So that's a much smarter way to do it, where you're still leveraging, the funds that are coming out of your house. It's still a loan, but you're able to get into your investments much faster.
Well, you mentioned a very key point, tax reduction, right? So, because I've seen we have a lot of high income earners and professionals whom we serve, they're in high income group, and the biggest challenge is tax reduction. And you know what? One concept, we were talking about old school, right? So, negative gearing and depreciation, what do you think about that? Because I'm seeing a lot of corporate people still in my general conversation catch up over coffee, beers. People say, oh, I have one apartment or one property negatively geared so that I can save some taxes. So what do you suggest? They're holding this property because for tax savings. Is that the right approach still true in the current scenario?
Yeah, look, again, I don't know exactly the scenario of the particular client, but and this is not an advice, but negative gearing can only stretch yourself to a very temporary cause, which is getting some dollars back from the government. And it doesn't serve the wealth building activity and the passive income journey that you want to embark on from a long term point of view. Right? At any point in time, a very high income earner, and we're talking people earning earnings are more than 200K plus, in which they're probably paying for every dollar 45 cents to the government, based on the current tax system that we have. What that actually means is that are people find it really difficult, and it is quite painful for people to see that 45% of the income is gone in tax. And there's nothing wrong with that. We're all humans. We understand if you're making half a million in a year and you've suddenly wiped off 200K in tax, that's going to hurt. So the point is, such people are obviously looking for immediate tax benefits, and of course, brand new homes or highly negatively geared properties attract them the most because they see that some money is coming back because of the deductions. Now, mind you, depending on the type of depreciation and deduction, the deduction may be temporary, because obviously you may have to give back the deductions when you sell the property. I'm not an accountant, but speak to your accountant about that. And that's why we don't promote land and house packages at all. But the key reason to get into that negative gearing position for tax savings is also not right, in my opinion. It needs to be a broader aspect of what that property is going to be able to do in the future for you. It doesn't make sense to me that you want to save 45 cents of new money that you're putting in, and spending on a property that may not even grow. Like you said, apartments don't grow in value, that we know in most cases. And what that means is then you're holding something just for negative gearing, and you're only trying to get 45 cents back from the government for a dollar that you're spending on it, and 55 cents is still with the government. My view is that if an income is coming from the property, why don't we keep the 55 cents of the dollar, right, and pay the 45 cents if you really have to? Although there are structures you can get into, in which when you buy a property in a trust structure, for example, you can maximize your tax benefits as well. Again, I'm not an accountant, but there are ways to reduce that 45 cents that you're paying to a dollar down to even close to 25 to 30 cents, depending on the structures chosen.
Yeah, because we covered a lot of things in this, because that may be overwhelming for some of the investor structures and all that portfolio, so many things together. The best way for my audiences who are new or who have just joined in, can you provide an example of a passive income portfolio you have built for a client, and what were the outcomes?
Yeah, of course. Look, I mean, I'll keep it simple. So let's say consider a property that you buy, first one being residential, right? And that property may be negatively geared property in a trust structure. For example, you're buying it in the company is a corporate trustee, and then you are buying the property in a trust structure, and you may be the beneficiary, of course, as part of that. Now, if that property is negatively geared, let's say it's negatively geared for the year by say around $5,000, right? Now you buy another property, another residential property after some time, and you're able to again buy a similar type of property where you're negatively positioned again for the year as 5,000. So now you're $10,000 negatively geared, correct? Now, what you could do is buy a commercial property as your third property in the same trust. Again, asset protection is going to be an issue if you buy multiple properties in the same trust. But for the purpose of trying to make you understand how things work, if you buy this third property in the trust, which is now a commercial property or commercial like property, which is giving a positive income at the end of the year, or positively geared property, and that could be a tune of, let's say, 15,000 positive, then what you've just done is that your net position from a gearing perspective is positive between the three properties in that trust. So you're actually getting, in this example, 5,000 net positively geared at the end of the year, which means now you have the position to distribute that $5,000 to either of the beneficiaries in your actual trust itself. What it also does is it gives you the ability to now use that advantage of buying these properties in trust. So maybe the loan position amongst those three properties combined together, let's say it's $1 million. You now can go to the bank. Of course, this is to be discussed with your brokers, your financial planners, and your accountants. But there is a way to go back to the bank and re-borrow the same $1 million, even if you did not have that borrowing capacity in your personal name anymore, to re-borrow that 1 million again in another trust as well, as an example, just because this property or this portfolio in this trust is now overall positively geared.
That's quite exciting, because that increases your borrowing capacity, and it's balanced way. Banks see it safe, and you're a good investor in the sense they are ready to de-risk their investment as well. So one thing, Anubhav, that comes out in this, I hear residential, commercial, and all. So what type of properties, for example, residential, commercial, or mixed use, do you recommend for passive income?
Yeah, look, passive income is a position where you can create a position like that. It's not about just a type of property. For example, I could have a property in which I haven't reviewed the rent at all, and the rents can go up. You can go back to your property manager and say, okay, can you review the rent? And current rent could be far lower than the market rent. So that's one way to increase your rental position straight away. You can look at your insurances again, and a lot of people have, maybe not the right type of insurances, so you might even need an insurance broker to help you with the insurances. But there are many companies out there where you can actually, get the right insurance for a much better premium as well, because that's a big cost as a result, right? We can't do much anything with the rates and all that sort of thing, because that's basically going to be there. But these are the two things that are in our hand, plus property management, right? So that you may be paying a lot more for property management as well. Although I don't say go to the cheapest, because you're not going to get the service. So make sure you have a sort of a balance. So optimize cost essentially, or direct expenses of the property. The second thing people can do with existing properties is see if there's opportunity for them to add a dual income coming from the same property as well. So in Victoria, for example, we are able to add granny flats at the back of a property. You can actually, of course, you still have to meet the code to make sure that you are able to fit the right type of a granny flat at the back, and it is all doable. But if you do that, you don't even need approvals. You can straight away go and start getting your income from the backyard, and your backyard can start earning income for yourself. So that's an option as well. The other third thing, easier thing, is that if you already have investment properties and it's a rundown property, you can look to renovate the property, and go with cosmetic renovation that can improve the value of the property as well, and also help you with your deductions as well, because you get the depreciation benefit as a result of whatever new that you put into the property. So it could be a new bathroom, it could be a new kitchen, it could be just an uplift of maybe a lick of paint can do a long way. Maybe it is adding air conditioning to your home, which it doesn't exist. There are multiple things you can do just to make sure the look and feel of the property is good, and it is absolutely going to be a viable option. Like we talked about the apartments, if you have apartments, you could look at turning into Airbnb. If it's in the right location, that could probably yield better results. Or even your property could be turned into a rooming house if it meets the legislation for that particular state. So existing portfolio can be repurposed the right way. But if you're in the market to buy something new, then of course there are strategies in the properties that can give you passive income from day one, commercial being one of them, of course, and not all commercials will do the job. So you need to be careful what you buy without losing your sight on growth. But commercial is also absolutely an option. Airbnb, rooming, NDIS is also big, which is National Disability Insurance Scheme. I personally don't like NDIS for multiple reasons. Again, that's not the purpose of this whole podcast, so I'm going to keep that aside for now. But those are still quite positive cash flow type of properties. And then we've got obviously block of units or dual occupancies, like I said about granny flat, but you could have block of units as well that can give you multiple incomes. So more the doors, the more income you make from the same asset. So that's the concept behind it. And you can turn it around by ensuring that you can actually get into that type of investments. So that's giving you the cash flow that's needed. It's balancing your negative position. And those who are looking at that original question you asked about, I want to save tax because I'm on a high income. This is completely contradictory, right? This is about saying save tax on new income that you're going to get, because at some point in time, the realization that you have to replace your active income with passive income, the sooner it actually happens for them, the faster they'll be able to get on that bandwagon and be able to look at a long-term position rather than an immediate position of how do I save tax on my dollars that are going out right now.
Interesting. And just for the general audience, right? A lot of people are DIY investors. They're also watching this for guidance. And what comes in my mind, if I'm just watching what you just said, hearing what you said, I would not say, what comes to in my mind is, do you recommend starting with a high yield properties, growth focused properties, or a mix of both? And why?
If you haven't bought anything till now, and you are looking for a portfolio that you want to grow and allow you to be able to get to a point, you need to look at what's your current weakness in your portfolio. Like, do you not have enough cash? Let's say there might be people who might feel that, if I buy another property, I'm not going to be able to hold it, or even if it's my first property, whilst I can borrow, the negative position can't hold me, I cannot hold the property. Then of course, high yield would be the right thing for them temporarily, right? And it's very much situation dependent. But those who don't have that problem, let's say they save $70,000-$80,000 a year. If you're buying one investment property that's going to be negatively geared for $15,000, you can easily hold that property for yourself. I would say probably without knowing much about the risk appetite and what they can do, I would say probably growth is probably your number one factor in that property. But you also look at ways how you can improve the actual income component within the same property as well, as I mentioned earlier.
It's a very common question which comes, and I get asked in a lot of social events, and based on lot of educations gurus available on internet. How do you decide the ideal number of properties for a passive income portfolio?
Ideal number of properties. Look, I don't believe in buying 15, 20, 30, 50 properties. It doesn't make sense. The reality is that whilst there is still a way to continue to keep borrowing money without you having to get stuck, as long as explained earlier, you have the trust, which is positively geared, you can still go on for the next set of properties in another trust. But The reality is that one, people don't need so many properties unless they just like to buy for reason. But if there is a very specific goal to achieve, then there is a finite number of properties that are required and the right type of properties. I'll give you an example, right? If you have one commercial property, let's say about $1 million worth of property, and that's giving you a net rent of $70,000 as a result, then that $70,000, after that, the only reduction that you have to make is what's coming out of is your interest component of your loan. And let's say that's another $40,000 that's taken off. You're left with $30,000 in your bank account as positively geared properties, right? Now, my question is that if I have to make 120K passive income today, right, and you're getting $30,000 on one property, how many properties do you need?
Yep.
How many properties do you need? Four,
yeah,
right?
Depends. Yeah. So
Yeah,
agree.
that's 120K for you, right? So you're getting 30,000 per property. You need four properties to make 120K. That's your goal, right? So, and that's what decides the number essentially. But if you don't have a number and you just keep buying the properties, you can. A lot of people want to buy properties, hold some, sell some so they can pay off the debt. That's also a good strategy rather than focusing on paying yourself. Especially the principal place of residence, you could build up your portfolio, add another property to this number 4, where you can add one more property, let that grow for some time, and then pay off your debt for your PPR as well. So it comes down to what is the purpose of building the portfolio, and that purpose can be met along the way. It doesn't all have to happen at the end of 10 years or 15 years. It can be unlocked as you go along.
Perfect, Anwar. Because pre-COVID, I used to hear a lot in social gatherings, everyone, I have 5 properties, 7 properties, 8 properties. Post-COVID, especially in Victoria, the conversation at the table is completely different.
Yeah.
And we know the reasons why.
There's a question from Saurabh. I just popped up. Okay. Where does the money come from for the trust in first place? Is it individual income? Yeah. So it does. So your income, because obviously the company, what we suggest is have a corporate trustee, which is a company, and you're the director of the company. So have a conversation with your accountant. But from a borrowing perspective, your broker can help you with that. It is taken into consideration your own income. And that's why there are certain banks who will ask for guarantees as a result that before they lend you money in the trust, they'll ask you for personal guarantees that you have to also maybe have to validate that with a lawyer as well during the purchase.
This is quite interesting because this is a very common question when we talk about trust and all that. People say, hey, who is bringing that money? Where the money is coming from? I'm the earner. It's my trust. How it works.
Yeah.
Anyways, definitely accountants are handy. Tax advisors are the best. Accountants are the best to advise or suggest what's right for you. Well, in the current high interest market, one thing that, we talk about cash flow projections. So how do we handle cash flow projections, especially in the high interest rate environment that we are currently? Because you have been serving clients for the last 6 years. You have served so many, 700, 800 clients till now. They have gone through the journey. Now they are at a stage of passive income as well. So how your cash projections stacked up in 6 years of their journey with you, portfolio building?
Yeah, look, I mean, the thing is that, of course, not all such clients would come back to you to review their portfolios, but the journey that we've seen so far is that when you buy your investment property, let's say you buy today, in today's numbers we'll talk because that's more realistic. So if it's a $600,000 property rented for $600 a week, with 80% LVR and 6.5% interest rate, which is today's numbers, you're looking at a negative position of close to around your negatively geared position close to around $15,000 for the whole year, right? So that's about $1,200 to $1,500 just to hold the property. And again, depending on what you end up buying, it may even be less as well. But that's the type of properties we are buying, which is sort of giving a position anything between 12,000 to 15,000 for the whole year as negative position. Now, historically, what we've seen is, and we are also projecting this in the future, that most of these properties are going to continue to see the rent increase. The rate of rent increase might not be the same as what we've seen previously, but it all depends on supply demand, right? Yet it'll continue to go up because we're not building enough. There is a absolute shortage of right type of properties, right areas. And that means that if rentals keep going up and keep climbing up, then people will find themselves in position where their overall, um, you know, negative position is getting diluted over a period of time. So what's 15,000 negative today as year one forecasted? A year two, if the rent goes up by another $20, $30, that starts to reduce. And then that's a compounding effect on portfolio when you have multiple properties like that. So my own portfolio in one of the trust structure, for example, I have 3 to 4 properties in them. Although it is not ideal because they say you should probably have one property every trust, but I just ended up buying 4 with one commercial in there to balance my portfolio. And what I've seen for the 3 residential that I had, it's sort of almost got to the point of very little to minimal negative gearing. And with commercial, it's obviously giving the final boost of getting the positive gearing going. In fact, I was having a chat with my broker only today. Is to continue to keep reviewing every 2 to 3 months your finances as well. Are you still paying the right interest rates? Is there a better plan outside there? What sort of fees are going out of your bank accounts? It helps keep things into perspective, right? Do you want to reconsolidate your loans? For example, you could have personal loans, you could have credit card loans. That's probably stopping you to borrow more. And you could probably bring that all into one loan as well by doing debt consolidation as well. And that's a good strategy to look at how you could pay off your loans faster. As a result, even car loans can be rolled into it if required, because these are all high interest rate type of loans, and that can free up a lot of your cash flow position just by reorganizing your finance the right way. So you need a good broker who can look at everything and say, here's step 1, 2, 3, 4 that you need to do, and that can free up X dollars for you per week or per month or per year, which means you suddenly feel a bit of relief. Now that doesn't mean you go and spend the money in casino. It actually means that you start focusing on investing that money in the right place, so you can continue to build your portfolio.
Yeah, Anubhav, I was in Sydney last week over Christmas, and meeting people. It was my personal visit. The message, I hear a lot of commercial in your conversation, how you can cash flow, positive cash flow is commercial. So are we saying Anubhav is advocating for commercial and Find My Real Estate overall is pushing, not pushing, is more of towards commercial angle as well? Or we are trying to build a diversified portfolio, add that component to balance it, especially for the people who are holding highly negatively multiple properties, which are highly negative. So I would love to hear from you, because the message getting outside is like, hey, Anubhav is talking about commercial more rather than residential, and commercial is the only way forward. So I would suggest that, I would request you to what you are thinking in your mind. Why are you suggesting when we can bring in commercial in our portfolio, or also clarify that Find My Real Estate is not just talking about commercial. It is just that we talk about diversified portfolio, and commercial is one of the options in it as well.
Yeah, look, I mean, I guess they're not entirely wrong to what we are saying at a point in time right now, because there is a problem on the ground. Most people are not thinking, they don't know about commercial, they don't know anything about commercial. So they can go back to our previous live recordings and see those. We've covered commercial in a couple of them now. But it's a need of the hour right now. A lot of people are facing the crunch. It's a reality on the ground. People are facing problems in holding portfolios, and they're selling portfolios, but that is also not selling to the price point they want. So it's a catch-22 on the ground, right? And it is quite real at the moment. So therefore, the only way to try help people with a lot of their negative position is to balance that something with positive. Now, if I look at positively get type of strategies, or the strategies that people will be able to unlock their position straight away by balancing the cash flow positions, is commercial comes very naturally to me, is because it is quite widely known. Banks like it. Banks understand commercial very well, and people can see commercial every single day, so they understand commercial from that aspect. The moment I add other things like Airbnb, rooming houses, NDIS as options, suddenly these are like unknown uncharted territory for a lot of people, and there's automatically inherited risks that people see, even if it is perceived risk for them. People are not open to that conversation as their first property, second or third. But when we talk commercial as a second, third, fourth property, people are very, very open to that conversation because now they've built enough portfolio where they can still get the right type of lending, and they're able to, balance their portfolio with commercial. So the intention always is that we want to have a very balanced approach for clients and actually build the right portfolio. But because we have done already so many properties with too much residential for them, people are at a point where they want to explore how you could actually balance the portfolio, and start to continue to keep building the portfolio rather than actually getting stuck. So one of the primary things is that we're thinking, how will you be able to buy your next property after you buy this one? And that's important thought. No one thinks about that. How are you going to even exit from a certain the current property that you're trying to buy before you even enter into it? And this is like almost reversing the whole process and saying the other side first before you even enter into that round, for example. Right? So people are not wrong when we are trying to educate people about commercial, but what ends up happening with the individual person will depend on their circumstances and their risk appetite.
Yep, I fully understand, and it's all about your own risk appetite, right? Commercial comes with their own risk, and I have seen your last Q&A with Puru. You did emphasize on, is it right for you? That needs to happen. Every individual's risk appetite journey in property is different, so be very mindful. So it's when we talk about commercial, there's an option available, can be explored. So we are not limiting ourselves with just residential and saying this is the best. We have all the options and we can pick and choose. It's like a puzzle. We can pick and choose and take it forward. I think Saurabh has two more questions. I think first question, where does the money come? The second was, the way to go is to have one property within a trust and then have multiple trusts. You answered it. Recommendation is that. And any suggestions on Saurabh's question?
Yeah, look, I mean, I think that's a question mainly for their accountants and also the broker, because the book says one property, one trust to maximize your asset protection. But the reality is it depends on whom you're borrowing with, what you're doing, and there are practical nuances around this. So you really need to have the right conversation with the accountant and broker to make the right decision. I can't just simply say what you should do. But the book says ideally one property, one trust. That's what it is. It can be an overkill if you have 5 or 7 or 10 properties. With 10 trusts managing, it's just a nightmare. But for the right reason, you have that property. For example, even in superannuation, in SMSF, when you set up a trust structure to create an SMSF self-managed super fund, your assets are in there, which is your cash and your other thing, and maybe you buy gold or you buy crypto or you buy memory blurs, whatever you need. But the moment you end up buying a property in super in SMSF, what you're actually and you're going to borrow against that property in super, then the bank will force you to open another trust, which is called a bare trust, and that's where the property is actually held, because they want to maximize the asset protection. And if you buy a second property in SMSF, then you'll have to go for another bare trust, which means one property per trust, being the concept of around maximizing the asset protection. So the same thing applies outside. If protection is your main thing and that's what you want to do, it's one trust, one property. That's what the book says. Practically, what's possible, you have to discuss with your professionals.
Interesting. And one more thing, when the high income group, right, the people in high tax bracket, they're holding multiple properties negatively geared, thinking that they are saving taxes. So what's I know we can't give an advice, but there's something I have heard you talking about, opportunity cost based on the current market where they are holding the kind of properties that they are holding. So I would like can you just emphasize on, if people who are just sitting on heavily negatively geared multiple properties, what they should look at, not giving an advice, but from property lens? Thank you.
Yeah, look, opportunity cost analysis is very poorly done with a lot of people not realizing that 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 needs to be done to really realize what are they sitting on. Are the properties going to really grow as much as they anticipate when they first bought the property? And it may already be, a couple of years or maybe 3 years or 4 years since they've held that property or portfolio, and they haven't seen any much growth happen, and they may not be in a position to forecast growth for that, but they're just holding because they either like it or they're just too busy to do everything else and they just want to keep accumulating assets without even considering selling. I used to a long time ago think like, why even sell if you don't have to? And that's true. But the thing is, if it's going to weigh you down on your negative position, or even for that matter, your borrowing capacity is being challenged, then it is time to actually, review the portfolio. And that's what I mean by cost opportunity. So the point is, if I sell something and I free up my 500,000, for example, by selling a property, how, and if I end up buying something else, how would basically the two assets look like if I was to hold the same asset for the next 10 years versus buying another one for the next 10 years? And when you do that apple for apple comparison for looking forward into the next few years to come, then you're actually able to make a, a, the correct call on the projection you might have on both the properties and actually giving you the right view that is this even the right thing to do. But that opportunity cost analysis can only be done when you understand the landscape of all the strategies available in the property and where those type of properties can be available around the country. Now, most people are um, those who are buying themselves and have been building things themselves are mostly doing or buying properties in and around where they live, right? Within the 5 to 7 kilometers. And you'll only see the same standard properties everywhere. So when they're trying to recycle or looking at opportunity cost, and if you're looking at your 5 kilometer radius, it's not going to change much, right? There's no point doing recycling because okay, this is not working. Let me go 5 kilometers away, and maybe that's a better property. It doesn't work like that. It might be that a strategy might need a change. For example, you're just buying and holding a brand new property with a 200 250 square meter land, in one of the metro areas, and that's not growing much over the last 5 to 10 years. But you're still holding it because you like the property, and at some point in time you might want to give it to your kids, or maybe you are thinking of moving in that property after 10 years, and it's not something for today. Then you could be sitting on opportunity cost straight away, right? Because anyway, there's no growth. Future, if there's nothing much coming, then you're holding something which doesn't make sense. As an example, you could recycle that property and buy something in completely different state where you can get 10, 15, 20% growth as well, depending on the last 2 years, what we've seen. And you could be much better off financially down the line.
I think two Saurabhs are on fire. One is Saurabh Karkra and Saurabh Mishra. So I think Saurabh had a question. I think he has 3 or 4 questions combined. So how do we deal with or protect against vacancy in commercial? That's a risk, right?
So, sorry, what's the question?
Vacancy risk, right? How do we deal with or protect against vacancy in commercial?
Oh, in commercial properties. Look, I mean, this is why we love multi-tenancy type properties, where you can get a mix of different tenants in the property. And of course, choosing the right location, right area could actually serve the purpose. The size of the population in the town, the demand supply, and looking at the future forecast of the area, the growth, what infrastructure is going in there, what sort of people are living there, the demographics of it, how many commercial properties exist, what type of commercial properties are there, what type of industries exist over there. That can all basically, reduce the risk that you're going to inherit. But within the property itself, if you have multi-tenancies, then that can significantly reduce your overall dent on any long vacancies that you might see on a particular lease as such.
When you say multi-tenancy, it could be residential and commercial, like some town, some rooms above, so that, just 2 or 3 retail shops below and 2 or 3 accommodation townhouses or something on the top, so that you get multiple sources of income from the same. Yes. If one goes, you have some source.
Yeah, it's called mixed use or residential. So you've got, like, typically we've seen this a lot type of structure in older areas where you've got shops at the bottom and you've got residential on the top or at the back. But it could also be multiple, shops as well. Not doesn't have to be residential, but that could also mean multiple tenancies as well.
So the next question is just related to it. Are they more market sensitive, and can we trust them to sustain economic ups and downs, same as residential?
Are they more market sensitive? Yeah, so look, market sensitivity can depend on activity within the market itself, and no market can go all in straight line. So there'll always be cycles out of it. But the point is that a growing market and a sustainable market will always be able to, in a long run, be able to give you the benefit of both growth and cash flow over a period of time, right? For example, if I in a thriving area, if I buy a commercial property in which there is a dire need for, let's say, a warehouse, and the risk of that area being flooded with other warehouses is not much, and there's not much land available where they can continue to build so many warehouses, then of course your risk is contained, right, to a large extent. And growing population will always need that warehouse. If you buy too large a warehouse, you are already inheriting risk because you need such a big tenant to be able to occupy that. If you buy a warehouse that you can subdivide into, not even, sorry, so not subdivide is not the right word, it can be misinterpreted. Let's say you partition that warehouse with multiple tenants in there. Now you can get smaller tenancies to deal with it. For some people, it's a nuisance dealing with multiple tenancies. That I don't want too many people, dealing with one property, which is the same as in residential, a rooming house. If you can have 5, 6, 7, 8, 9 different type of tenants, people don't like that concept of having multiple people in the same house. Same thing with multiple tenancies as well. So they might not like the idea that they're all under one roof and there's partitions around it. But the reality is that that's a risk mitigation strategy, but also high income strategies that can actually give you passive income straight up, pretty much. Right. Yeah.
Related to commercial, he has another question, which is: are there any regulatory gochas in commercial based on different properties, type of properties in commercial?
What does that mean? Sorry, I don't understand.
I don't know, he has not. So I think that needs to be clarified, because I fully understand that warehouses will have a different, and based on the lease agreement as well, there are every commercial property, different leases also changes the way you can use that property, and that plays a critical role in your income. Anyways, Saurav, if you're listening, I will get back to you on that. We'll need some clarity on your third point. And I'm quite keen on the fourth point, which you have mentioned, which is capital gain limited or comparable, or is purely a cash flow strategy? Commercial, it's about commercial strategy. Is it limited or comparable from the cash flow perspective?
No, not at all. I mean, the growth is quite directly proportional to the income you can earn from the property, and also the risk that you can reduce in the property, and to a large extent also how the area overall is doing. So cap rates can actually go down over a period of time if you understand what cap rates are, and capitalization rate. That's what I mean. So the cap rate for that type of property in that particular area is, let's say, 10%, and if it goes down to 8% over a period of time in that particular area, it means there's more demand, less supply, and there's actually more activity happening, which is why capitalization rate has gone down, which actually means that your property value has gone up, right? So there are three factors really, and if there's no change in your rental position of the property, if the rent is not growing, if the risk is not being reduced and the risk of that particular asset is the same, and if that area is growing just normally as residential would grow in the area, then commercial will always follow residential, because there's as a market, commercial is only 10% overall as in valuation as compared to residential. So therefore, commercial will always follow residential, but there's ways to change the fate of that commercial property, which can be quite out of proportion to residential as well. So as an example, there was a property, the property purchase in COVID for 800, 900K, sold for 1.5 million after 3 years, making 600K in profit, which is, again, quite substantial. But there is a COVID element into it. So if you take the COVID element out, I'd be happy with 300K uplift, in 3 years from a profit like that in commercial. So there's similar strategies that you can implement in commercial that you do in residential. But the gain can be quite significant in commercial if you play it right.
So high risk, high gain. So,
Not necessarily high risk. I wouldn't say that. That's not the right way to put your commercial into perspective. The highest risk is, well, first, not doing anything. Second is actually doing only negative gearing because you're not really growing your portfolio.
and one thing comes on my mind: market trends are changing. So when recommending properties for long-term passive income within a portfolio, how do you account for market trends? Because nobody has seen the future, right? So, and we are building all this for cash flow, maybe in next 5 years, 10 years, based on individual goals. So these market trends are continuously changing, and we are building a portfolio for our clients based on a strategy. So how do you make their strategy resilient to all these ups and downs so that they achieve the outcome in next 10 years what they wanted?
Yeah, look, no one's got a crystal ball, and we certainly don't. The point is that it's a projections based on certain assumptions that we make, but at no point in time we are repeating a strategy for the client within the portfolio, or even for that matter, the same area or state. So that actually itself is, diversification. The more we diversify with different things in there, the better chances that your portfolio will actually come out shining. So, in fact, one of the clients I remember sent me a constructive feedback. He said, "Oh, why did you buy me in South Australia but not in Perth? I could have got more growth." And I'm like, "Dude, I don't have a crystal ball to tell you Perth would have gone, far ahead of South Australia about a year and a half ago." But the point is, if your portfolio is gone up say 12% and Perth is giving you 18% return, there's still a return there. So if at that point in time, based on the suggestions we had made, if the client had bought two properties at the same time, one in South Australia, one in Perth, that conversation would not happen after 1.5 years by talking about, okay, why I should have bought in Perth. It's more to say no one knows the future, but have you diversified enough to allow the best outcome for your portfolio?
And also, Anubhav, in this, what example you mentioned, it's about the client's borrowing capacity as well at that point of time. Even 1.5 years ago, if you're buying something in Perth, you need a bit of a borrowing capacity plays a major role. You just can't enter the market. South Australia market from the borrowing perspective is different,
Yeah.
and as compared to Western Australia. So there are so many levers before you enter in a growth market, and I believe that's part of your strategy, risk analysis, and everything. I have a curiosity, since we're talking about commercial, we talk about investment in residential, about regional and metros. Do you see the same pattern conversation investing, buying commercial properties in regional areas versus metro? Or they are similar, risks are similar, growth is similar? What do you think?
It's a typical regional metro conversation. And I've had multiple debates over these years with regional and metro. Those who never believed in regional uh, can now see the reality and facts when I've been trying to scream this over my lungs 6 years ago that why we were buying in regional back then. And the results are quite clear that regional has done phenomenally well over these years, right? Um, See, the fundamental approach to commercial with regional versus metro will come down to budgets, will come down to the type of asset that is suitable, the risk appetite that people carry. And of course, the point is not about you'll get more growth in commercial regional versus metro. It's more about how does that particular type of asset will suit their positioning. For example, if you have $1 million to spend and you want to buy something in metro, more of the likely, depending how far you go metro, you might end up buying something in a strata, for example, right? And most people don't like strata. They want independent land, they want independent property. So in that scenario, if the same budget prevails, then you might be better off going to nearby regional, which is still a large city in its own right, that you can get something which is far more decent. For example, in Victoria, Ballarat, Bendigo, yes, they're regional markets, but they are cities in their own right. I'm not suggesting go there, but I'm just giving an example. Even for that matter, Queensland, Gold Coast is regional, but it's a city in its own right. I mean, you can see the growth of, Gold Coast over the last 5 to 6 years. It's phenomenal, and still more to come. Again, please don't disclaimer. I'm not saying go buy in Gold Coast, but I'm just saying that is coined as regional versus Brisbane being the metro.
Yep. So, Anubhav, this would be my last question, but a very open ended question, putting you on spot.
Thank you.
The question would be, I would like to know, imagine Anubhav Agrawal, who is an investor who wants to invest now, and he is listening to all our podcast, overwhelmed with the information, so many Facebook groups, so many posts. This is right for you. All gurus, all motivators, all social media influencers. So, how would Anubhav Agrawal just take off your hat of a strategist, property enthusiast, investor? How would you be feeling when you are listening to all this going through around? What would be your 2 cents for a newcomer or a new investor to step into? How can he gain some courage to step into the market step by step, start somewhere? Because so much information is available. I think the people are just crashing down, they're overburdened, they can't make any decision.
Yeah, look, I
So
mean, I love to say go to the right buyer agent, but that's not the only thing that I'm going to talk about. The thing is that if I put myself back 25 years ago when I was in this position as well, the best way would have been to get educated, right? And education doesn't come from social media. Education comes from authentic sources and listen to a lot of authentic podcasts, essentially, that people are talking to. Some people like to read, some people like to listen to. Whichever way you prefer, get educated, get yourself accustomed to the different types of things that can happen in the investment world. Of course, this is time consuming activity. It can take you 6 to 8 months to even do that. But if you're willing to spend the time, do that. If you want to fast track it, you need a professional next to you who can talk about that very quickly, get things going for you, and really do the analysis and tell you what's right for you. And you just get on the bandwagon the way we do it. And we didn't have buyer agents back then, but now there is a growing plethora of buyer agents who are also quite limited in their own knowledge and experience. So if you choose the right people, right professional to help you, there are financial planners, there are brokers, accountants, and of course, if you ask the right questions, you'll get the right answers from the professionals. Don't read social media alone, but go to the professional and get the right advice and work with someone you can trust, because the most important bit is that it's your portfolio, it's your life. If you don't take action, nothing will happen, right? The faster you take action, the faster you'll be able to move into the world of investment. But having the right guidance, yes, you spend a little bit of money on professionals, but hey, I mean, how much money did you spend on it getting educated to the amount of money you're trying to earn today, right? And how long has it taken you to be in the same industry you're working right now before you can earn the money you're making today? So why not pay someone else to really get you going and who can fast track your journey?
And next thing is, Anubhav, based on your experience, your journey strategy, how do you look at the clients? Because if your clients, you're educating them so much, they're coming, they are time poor. People like me in my 4 years ago when I engaged you, time poor people don't know much about property. Trust Anubhav started it. If we start buying on our own second or third property based on the education and the journey we have gone through, how will you run your business as a buyer's agent in future? So you're risking your own business plan if you're educating your clients in the buying journey itself with different strategies and everything. They will go and do it themselves, DIY.
I'll ask you the question differently, Harshit. Do you eat Nando's?
Yes.
They sell the sauces as well. Why do you go to Nando's and not make it at home?
Oh, because they have the best chips. One of my reasons, because I'm a vegetarian. But you're right, actually. You're right.
Right?
Because
The point is not that. The point is, a lot of there are companies out there who are saying don't use buyer agents and just get educated, do it yourself. Yes, do it yourself, right? And you should. Unless you make a mistake, you won't understand the value the professionals bring. We have a client who actually reached out to us, and they bought two properties back to back with us, pretty much, and had a significant growth of 51% in 15 months, essentially on each of those properties, which is quite ridiculous actually to see that type of growth. Even I'm quite surprised myself, but it has happened. Then they got educated through a course online, and 6 months they did that course, thinking that they'll do this on their own and able to invest. And they did the course for 6 months, and soon realizing I'm actually don't have time. I'm now educated, but I don't have the time to do it. Anyway, I trusted the team who's done phenomenally well for my portfolio. Let me go back to them and buy my third property right now and the fourth one. So they're buying third and fourth now almost in parallel, which basically means that, the reality is we are time poor. And the reality is that if you're making money and you're making 51% growth in 15 months on your assets, right? That's a significant wealth position in such a short period of time. I'm not guaranteeing that. We're not saying that's what's going to happen, but that's what's happened for that client, right? Why would you try to save pennies when you can actually focus more on real thing that matters, which is your growth, your passive income, and your portfolio that's going to help your future generations to live on comfortably.
Brilliant, Anubhav. That's the best thing to end. In fact, sorry, I put you on spot. That was out of syllabus, out of something, how Anubhav Agrawal will feel. Because let me tell you, when I go in my social surroundings, that's how people are feeling right now. Okay. And thanks to our social networking, birthday parties, dinners, lunches, Christmas, New Year, all that's happening around, lot of questions. Everybody wants to be an investor, Anubhav. Every next person I meet on the road wants to be an investor and has a strategy on his brain. Either he's starting some new courses or part of some group, which is good. But is it right? That was the reason I put you on spot and asked that question. So, guys, knowledge is available, information is available. You have to make a decision, but you need to act. Do whatever suits you, but you need to act. So all good, Anubhav. Thanks a lot for your time. And this was
Thank
my
you.
first Q&A this year, and there will be a lot. This was really exciting, quite interesting, and even there was some aha moments for me as well, for me to reflect on my investment strategy. But great. Thanks for your time, Anubhav. Thanks, everyone, for
No,
joining and asking
thank you.
questions.
Thank you. Have a good evening. Bye.